Welcome to the fourth module of financial management. And today we'll be discussing on risk and return in financial management. Risk and return in financial management, where we'll explore how risk and return guides investment decisions and resource allocation. I want you to be ready to learn and be very ready to also go through the notes that are provided for more explanation on the topic. You see, this topic is very, very important in financial management. Understanding the risk and return, if you will invest, these two components are very important. You look at the risk of your investment in investing in it, and you also look at what return you'll have to gain. And in the process, you will understand what these two actually means. The model will put us through the concepts of risk and return, which provides a foundational understanding of how they are defined and related. We look at expected return and standard deviation plus variation, which actually talks about the measurement of risk. We will also look at the capital asset pricing model and beta, which provides theoretical and practical tool for measuring risk and determining the required rate of return on assets. What do we understand by return? Return is the reward or compensation an investor receives for investing capital in an asset or a business venture. So if we will explain that, it is what you actually expect to get from you investing in an asset or a business venture. And it represents the gain or loss generated on an investment over a certain period of time. So what you investing in a business on an asset does not mean you will surely get a gain. It actually means you can have a gain and you can have a loss. It's 50-50. That's why we need to look into this concept of financial management. So return is typically expressed as a percentage of the initial investment, and it is used to measure the performance or profitability of an investment. We have two components of return. We have the income return and we have the capital gain or loss. And for income return, this includes periodic earnings such as dividends from shares, those from interest, from bonds. Those are the income returns. On the other hand, for capital gains or loss, this refers to the increase or decrease in the value of the investment. That is, the price appreciation or depreciation of an asset. That's the two components, major components of return that we have. And we have the formula there where we see the income plus brackets open ending price minus beginning price, all divided by beginning price times 100 gives us the return. That's giving us a percentage of what we said is the initial investment. And for example, if an investor buys a stock for 1,000 and receives 100 naira in dividend and sell the stock at 1,200 naira, the return is what? From the calculation, you see that we have a percentage return of 30%. 30%. This tells about the gain that the person, the investor has. So he got a 30% as such. So we move further to risk. Risk refers to the uncertainty associated with the expected return on investment. So we've talked about a return, and now if we say risk, it is that uncertainty that is placed upon an expected return. Like it is what you aren't sure that you will actually get the return. So you place a risk on it, and it is the possibility that the actual outcome, which is a return, will differ from what was expected, which could mean earning less than anticipated or even incurring a loss. So you can incur a loss from the return from the investment, or even if you anticipated a 500,000 naira um, return from an investment, and you are getting about 200,000 naira, 300,000 naira. You had a gain, but it is not an anticipated. It is not what you anticipated. So that's still a risk. So in finance, risk does not just refer to the chance of loss. It also includes the possibility of all outcomes deviating from the expected returns, both higher and lower. So it can be higher and it can be lower. For example, stocks are considered riskier than government bonds, but they also offer the potential for higher return. Also, risk in finance can be classified into two: systematic risk and unsystematic risks. You will understand that as we go by. So understanding these two categories helps investors and managers identify, measure, and manage the potential threats to an investment return. The types of risk that I said is systematic risk, and it is also called the market risk. Systematic risk refers to the risk that affects the entire market or a large segment of the market, and it is not uh, diversifiable, um, meaning it cannot be eliminated through diversification across different assets or sectors. We have examples of systematic risk to be interest rate risk, inflation risk, recession risk, political risk, and currency risk. For unsystematic risk, it is also known as specific or idiosyncratic, idiosyncratic risk. Uh, it is unique to a particular company, its industry or sector. It is diversifiable, meaning it can be reduced or eliminated through diversification, holding a portfolio or uncorrelated assets. So it's an opposite of the systematic risk, which unsystematic cannot, the risk can be reduced or eliminated. Examples are business risk, financial risk, operational risk, legal or compliance risk, and product risks. We also have other classification of risk which are cross-cutting types. We have the credit risk, we have the liquidity risk, the investment risk, we have the sovereign risk, and we have environmental, social, and governance, which is ECG risk. We have it stated there, and they are well explained in the notes. You can go through it. Now, how do we actually manage this risk? It is important that we know how to manage it. And we said for systematic review, systematic risk, it cannot be eliminated. So we need to actually manage it. So it is generally compensated by a risk premium. So since it is not, it cannot be eliminated. So a way to compensate that is by risk premium. And also it is managed by hedging and asset allocation across region or asset classes can help mitigate the impact. So hedging and asset allocation helps in managing this kind of risk, or asset classes which can help mitigate the impact. And for unsystematic risk, a way of managing it is it can be reduced by diversification, which is holding a portfolio or of different securities across sectors and industry. Also, a way to manage it is the due diligence and analysis of investors, company investor want to invest in. And lastly, the way to manage is using insurance and contingency planning to cover operational and legal risk. What are the relationship between this risk and return? And when we talk about this, seeing a higher risk, it means that the higher the risk, the higher the potential return. And for the lower risk, the lower the risk, the lower the potential return. So the more you sense a risk, the height of the risk, in the same proportion, the return also will be, the potential return will also be. So this is very important for investors who are investing in it. So this relationship is known as the risk return trade-off. Rational investors are generally risk averse. They will only take on higher risk if they are adequately compensated through higher expected return. How do we measure risk? This can be measured in a number of ways or methods or tools, and we have a number of it. We'll be talking briefly. They are well explained in the notes. We'll be talking briefly about the standard deviation, variance, and beta. And for standard deviation as a means of measuring risk, it measures the volatility of returns around the mean, and the higher value indicates greater risk. So if we quantify or calculate the standard deviation, the risk using standard deviation, if there is a higher value, it indicates a greater risk. So for variance, it's square of standard deviation. It is the square of standard deviation, and less intuitive but essential in modeling. It is actually less intuitive, but it's essential in the aspect of modeling. And the last one is beta. It measures systematic risk relative to market movement. So it is based on the movement of market. And when beta is equal to 1, that means it moves with market. When beta is greater than 1, it's more volatile. And when beta is less than 1, it is less volatile. Another aspect of risk in financial management is the capital asset pricing model, which is another important one. And what is the purpose of it? It is to calculate required returns. It is used to calculate required returns, and that places a great importance on it. So the CAPM is a model that describes the relationship between the systematic risk, which is market risk, and expected return on assets, particularly stock. And the CAPM is used to determine the appropriate required rate of return for an asset, the price risky security, and also to assess if a security is fairly valued, given its risk and time value of money. So the application of it is based on used in portfolio design. It is used in portfolio design. It also used in costs of equity estimation. And lastly, it is used for performance evaluation. It is used for performance evaluation. However, it has a limitation. When we talk about the limitation, it assumes a linear relationship between risk and return. Also, it relies on assumption of perfect markets. It also assumes single period investment horizon, and investors holding diversified portfolios. And lastly, beta may not capture all dimension of risk, especially during economic crisis or liquid market condition, market condition. In conclusion, in financial management, the concepts of risk and return are fundamentally interconnected, forming the basis of all investment decisions. So the lesson has demonstrated that every investment carries inherent uncertainty, which is risk, with higher potential return, typically requiring acceptance of greater risk. So the greater the risk, I want you to remember that the greater the risk, the greater the income, and the lower the risk, the lower the potential return that is expected from it. Next module, we'll be talking about capital budgeting, another very important aspect or financial management. Thank you.